Step onto any retail trading forum or financial media broadcast today, and the consensus on Opendoor technologies reads like a post-mortem of the 2021 hyper-growth era. With the stock lingering in the single digits, public market sentiment routinely frames iBuying as an ill-fated pandemic experiment, a capital-intensive anomaly that caught a fatal cold the moment the Federal Reserve began its most aggressive monetary tightening cycle in 4 decades. But while retail investors stare at historical chart damage and whisper about liquidity crunches, institutional capital accumulation tells an entirely different story. Behind the screen of normalized market volatility, a structural reality is being priced in that Wall Street consensus completely misses: the fundamental physics of residential real estate transaction friction. Traditional home sales remain a multi-month, high-friction, emotionally fraught ordeal defined by opaque broker commissions, financing contingencies, and systemic illiquidity. Opendoor is not merely a home-flipping balance sheet. It is building the high-frequency trading infrastructure for a $6 trillion asset class that has resisted digital transformation for a century. The market mispricing stems from treating Opendoor like a traditional cyclical developer rather than what it actually is: a programmatic market maker engineering structural liquidity for the most illiquid collateral on Earth. Market dynamics and institutional positioning. Daily trading volumes in Opendoor reflect a classic tug-of-war between short-term macro jitters and long-term algorithmic accumulation. Whenever Treasury yields tick upward or regional banking jitters threaten mortgage spreads, retail panic selling triggers sharp drawdowns, shaking out leveraged weak hands who view the company purely through the lens of housing market affordability index swings. Yet beneath these high beta gyrations, institutional heavyweights and specialized quantitative funds quietly sweep up float during macro-driven pullbacks. They understand that Opendoor's asset turnover metrics, pricing model error rates, and inventory holding periods operate on entirely different feedback loops than retail sentiment charts suggest. As the housing market transitions from the acute paralysis of rapid rate hikes to a new normal of structural inventory gridlock, platforms capable of instantly clearing residential risk are shifting from speculative plays to mission-critical ecosystem utilities. Before we unpack how this automated engine actually functions beneath the hood, let's check the pulse of our community. How are you currently positioned in the name, and are you accumulating shares during these macro-driven dips or waiting for confirmation of a broader housing turnover recovery? Business model and historical context. To understand where Opendoor is heading, we must strip away the outdated historical framing that compares it to traditional brick-and-mortar brokerages or legacy real estate syndicates. In its earliest iterations, the iBuying thesis was often oversimplified as a digital home flipping business model: buying low, holding inventory, and hoping for general home price appreciation. That linear perspective fundamentally misunderstands the modern data-driven architecture. Opendoor operates as a programmatic market maker, capturing a spread through transaction fees, operational efficiency, and advanced predictive pricing algorithms rather than directional beta bets on housing booms. The company's core operational engine leverages a proprietary database encompassing millions of historical transactions, hyper-local neighborhood comps, structural property nuances, and real-time supply-demand velocity metrics. When a seller requests an offer, Opendoor's automated valuation models ingest thousands of variables to price the risk instantaneously, offering certainty and speed in exchange for a service charge. This contrasts sharply with the traditional real estate model, which relies on subjective agent opinions, protracted staging periods, open houses, and a high probability of deal collapse during the financing contingency phase. By replacing human friction with programmatic execution, Opendoor transforms real estate from a relationship-driven negotiation into a scalable, high-throughput digital transaction pipeline. Future outlook, catalysts, and risks. Looking toward the multi-year horizon, Opendoor's growth catalysts are anchored in its evolution from a standalone direct buyer to an indispensable platform ecosystem for the broader housing market. The integration of the Opendoor exclusives marketplace and partnerships with traditional real estate brokerages allow the company to monetize traffic even when it doesn't take homes onto its own balance sheet, shifting toward a capital-light marketplace model that reduces risk while expanding total addressable market penetration. Furthermore, as the macro environment stabilizes and mortgage rate volatility subsides, transaction velocity across the broader housing market is poised for a structural rebound. Pent-up demographic demand, particularly among millennial and Gen Z buyers entering prime home purchasing years, demands digital-first, friction-free experiences that legacy brokerages simply cannot deliver. However, navigating this path requires acknowledging formidable risks. Geopolitical shocks, persistent inflation prints that keep mortgage rates elevated, and regional housing supply crunches can compress transaction spreads and extend inventory holding periods, placing immediate strain on working capital. Additionally, capital expenditure cycles and the cost of debt financing remain critical variables for a business model that requires revolving credit facilities to fund asset acquisitions. Despite these near-term headwinds, looking past the short-term price noise reveals a transformative enterprise solving one of the most stubborn bottlenecks in global finance. Opendoor is engineering the future of property liquidity, and those who mistake cyclical growing pains for structural failure miss the inevitable destination of digital transformation.